All right. Good morning, everybody. Seems like we're just getting started and it's already wild. It kind of got this feeling it's going to be a hurry up and wait week. And that's going to make it kind of boring for the first part. But we have CPI Wednesday. We don't really have auctions that are significant. Never want to discount them, but still, they'll be on the back burner. And I just kind of got that hunch that's what it's going to be like. Still waiting on the Spot Gamma AM edition founders note. We'll get a little insight there on very likely on OpEx, right? They should start talking it up pretty early in the week. Green on the screen mostly around the world. Small caps are in the red. Hong Kong's basically flat. I'm tired already. We haven't even gotten started. It's going to be a week. Japan is leading the way, although I would stress caution on that. So we'll get the budget at 2 today. And then we've got auctions in the front end. Again, even though you don't see any for 11 or for 1 o'clock, if you see auctions anywhere, just assume that the other time frames have them as well. So today we have them at 11:30. I don't see any other auctions, but I'll assume that there's going to be auctions at 11 and 1. Keep in mind, this isn't a total list of all of the events today, right? You could go to a dozen different websites trying to get all of the events. You will never get them all. It's one of the reasons we say just watch the clock. It's a simple way to avoid the idea that you may be missing an event. Governments are lazy. They'll come out on the hour, on the half hour, maybe on the quarter hour. Just watch the clock. We're going to get Walmart this week. It's kind of a big deal. A couple others that are decent size. Home Depot's another one that generally has a backdrop to it when they speak. People tend to listen, especially when it comes to, what the consumer is doing. This is retail week, by the way. So a lot of retail stuff coming in. I think this is the biggest door I've seen in the futures, at least in recent memory. It's a door day one open range, DOOR. Day one would be the first day of the month. It's the yellow candle here. But a lot of people use a 3-day door. So then technically it's not day one at all, but still we call it a 3-day door. That is the range from 56 almost down to 51. That's wild. We got a half back level, 53.42. Although it looks like this needs to be adjusted a little bit. 53.74. There's a cog line at 53.92. If we mark this last run where the door is, 53.60. back above the 10-day moving average. So here's a problem we highlighted last week that was going to be an issue. So all of this volume back here, this high volume node, is going to act as a significant resistance. It still is. 5392 will be interacting with it, and then 5400. Round number to options level. And if we can get it through all of that, we still have 5450, 5432 cog line. High volume node up there around 5475. So it's just a lot of resistance to the upside. It's going to be a fight the whole way back. And it's not to say that we can't make the run, because I mean, we can, especially when we've got things like CPI going to help us do that. But that's the thing. We've got CPI this week. So I wouldn't be looking for, big runs between now and Wednesday. It can happen, especially if we get news that makes it happen. But that's the biggest news piece on the week. And then we get more big news Thursday and then OpEx Friday. So, if that's the biggest one and it starts Wednesday, why would we run before Wednesday? ADR levels for the day. This continues to confound people. I still get questions on this daily. It's simple math, right? If you have learned how to just calculate a regular average, not a weighted average or anything complicated like that, right? But if you have 5 numbers, you can add them together, divide by 5, and now you have an average of those 5 numbers, right? Well, this is a 21-day range. We can see it in the label up here. Average daily range over the last 21 days. We're looking at the highest point to the lowest point on a daily chart, right? So just go out to a daily, look at one day from the highest to the lowest. That's a number. Then go to the day before that, highest to the lowest. Take that number, and then the next one and the next one. Add those 21 days up and divide by 21. Now you have a 1-month average or a 21-day average. And of course, that gives us 4 lines. Right now, the average is 103 points. Well, these lines get drawn at 6 o'clock at night. So it splits that $103 into half and half. So we can go up 50, we could go down 50. That'd be a 100-point range. Or we could just go up 100, or we could go down 100. That's it. It's as simple as that. Simple works, by the way, right? It's why it works. If you haven't figured out by now, a lot of the funds out there aren't run by traders, and they're certainly not doing complex stuff because they're not smarter than you. They just have more data than you. We haven't hit the lines this morning, either side. We're a little closer to the upper ADR, but not by much, right? 0.25%. So we don't really have much edge in trying to call whether we're going to hit the upper edge or the lower edge of the red lines. Don't know yet. It's just too early. Plus there's no volatility, right? We're not doing anything. We have tried to break outside of Friday's range, and that went over like a lead balloon. So liquidity resides on the other side of the pivot. We were able to get into that liquidity, but not through it. We've got to assume there's still liquidity up there. You should be able to see it on the dome. You should be able to see those trades on the tape, like hitting a ceiling or an iceberg. So until we wipe out that liquidity, there's no reason to believe we're going to continue an expansion to the upside. How many times is the market going to try before they give up and maybe test these lows? We are continuing to make higher highs. So from that point of view, from where we opened last night, we set a higher high than this one, and then another one, and then another one. So we're grinding higher, and we could continue to grind higher all the way to CPI. Grinding, the markets can do whatever, right? But if you're looking for some big expansive moves like we were seeing last week, I don't think we're going to get anything like that, barring news, of course, because news could always change the narrative. I don't think we're going to get anything like that until Wednesday when we get CPI. It is worth noting these labels across the top. There's 3 different ranges here. Daily SD, this is calculated as a 1 standard deviation of what price itself is doing. Daily expected move, that's a 1 standard deviation based on the options on the implied volatility average within the options chain. 21-day average daily range, well, we just went over that, right? That's looking back over the last 21 days of what price has done on a day-to-day basis from its highest to its lowest point. We talk about volatility means movement, and how in a high volatility environment, markets have historically moved farther than we expect them to. That's kind of the whole idea, right? So if the expected move is 57 and the daily range is 68, just round either of those up and say it's 60 and 70. We're continuing to make 100-point move days. So, all the math is saying, yeah, about 70 points. What we are actually doing is, yeah, about 100 points. And it's interesting how all of those places like Spot Gamma, Trady Ticks, Minthor, they all boast about how significant their levels are and how most of the time their daily ranges are really accurate. But that, and that's what they run all their trades on, right? They run their condors on them, butterflies on their levels. They expect those levels to hold. But we're in that other period of time, right? If the trade's like that, a 1 standard deviation trade is supposed to win 70% of the time, we're in the other 30. We're in the period of time where those trades systematically fail over and over and over again. So, my advice continues to be, don't run an iron condor in this environment. You want to do butterflies, sure, why not, right? It's really cheap. And when they pay, well, man, they pay great. So why not? You want to do butterflies, go for it. But if you're going to do iron condors, be very careful with those. The payout really isn't all that great, and yet the risk is elevated right now, significantly elevated right now. We are going to be opening up above the weekly floor pivot. That would be this lower one down here, this really wide channel. In a wide channel, we imply, or it implies, that price really shouldn't break out and run this week, but it's a weekly pivot. So there's a lot of room on that, on how far we could go and still be considered not breaking out on the week. I do watch these levels on how far away from them we are. Last week, we set a considerable distance from that weekly pivot point, and once that was met, we didn't go past it again. I don't have a level on how far is too far from a weekly pivot. Right now, we're not too far, but we are opening away from it. One that tends to act as a magnet if we're close and we haven't hit it yet. A lot of times we'll just go hit it. Not necessarily saying that I think we're going to go down and hit it today, but it is worth keeping an eye on where it's at. And right now it's below us, a considerable distance below last week's weekly pivot. It's outside the range completely. They're not touching. And, at first glance, it's about the same size as last week's too. The floor pivot for the day, smaller channel. in relation to the weekly, it looks like a very narrow channel, but it's not as narrow as it appears. If we were looking for a really narrow channel, which would imply that breakouts can hold and we can really run, we want it to be so narrow that we don't even see yellow lines or a cloud. We just see that purple line. That's as narrow as it could be, and it's not that narrow. It's not an MDP either. We've already hit it, so no missed daily pivot at this point. We had one Friday, however, and that does count for today. It's a missed daily pivot, MDT. It's not my strategy. I don't even trade it as a strategy, but it is insightful to understand the strategy, kind of have an idea of how these pivot points can provide context and insight on the market. If you want to know more about that, you can always search for it on YouTube. I don't get anything out of pointing you in that direction, right? It's not like I'm proposing that you trade it or anything like that. It's just more insight on pivot points, especially the basic floor pivots. We're at the volatility trigger. Really feels like that put wall moved again. I think in the founder's note Friday night, they talk about the put wall was moved up. Maybe I'm just still biased on that. But they talked about the call wall being a fake wall, which is kind of interesting. They've mentioned fake walls before. So they have an acting wall, and then they have the real call wall, which in the note they did say they felt fake to them. So if you didn't read the Friday note, it's worth just going in and taking a look at it. I know they speak a bunch of option stuff, and if you don't trade options, probably feels a little like it's over your head, but they do put some plain English in there. And when it comes to the call wall, they laid it out as just, they got an acting call wall, and then they've got their real call wall, which they think is not really a good one. So read the report. You'll see what I'm saying. It makes more sense. We're looking for that AM report to get some insight on the volatility trigger and the zero gamma. They usually do a really good job of mentioning these two levels when we're at those two levels, or if they think we're going to get to them within the trading day. The volumes are really light this morning, which is kind of going to my call that I think we could have a sideways weight. One of those weeks where we spend Monday and Tuesday just, playing the ranges. We were at 50K this morning, and it's not as smallest on record, but it's the smallest it's been in a while. Really low volumes can move the market, though. Just always keep that in mind. I know that confuses new traders, but in low volume environments, a couple of really big orders can move the markets because they don't have to work so hard, right? Think about the active trader, for an example, the dome here. The ES usually has hundreds of contracts per tick. So, if you come in with a 1,000 lot order, sure, you might be able to move a full point, but you're going to fill within those 4 ticks, and then that's it. That's about all the move you'll get, even with a 1,000 lot. But look at today when it's double digits instead of triple digits, a 1,000 lot order would move price considerably. So low volume, we can make big moves. We can also continue to make big moves while we're underneath this zero gamma level. Although there are a lot of analysts out, spot gamma type analysts, who are making the argument that for the gamma, depending on which expiration you're looking at, that we're in a more of a neutral gamma. And I've seen too that we're talking about a positive gamma structure. Take it with a grain of salt, right? I like consistency. So rather than shopping around, seeing what 3 or 4 different options analysts are doing, just stick with spot gamma, and that way the narrative stays the same every day. This is the cumulative volume index, and it doesn't matter what I have at the top of the screen because it's not looking at that, right? It's looking at the NASDAQ. So no matter what symbol I put in up here, it doesn't matter. It's just going to continue to look at the NASDAQ. Cumulative volume. So when it's going up, we've got cumulative buying volume. And if it's going down, we got cumulative selling volume. If you go to TradingView, rather than just looking at the NASDAQ itself, you could look at all of the US markets combined in a CVI. That's what you would search for, by the way, is just CVI or cumulative volume index on TradingView. You'd get the same indicator, the CVI, but you would have more choices on its markets. We're not back to the zero line yet. We kind of went sideways last week after the big drop, but we're back to the 20. We're still within the Bollingers. Just kind of spread it out a little bit, right? Like it does when it begins to expand, widens out the Bollingers. So lots of compression earlier in the year. We had that expansion in the later part of the year after that April decline, really. So we've had our decline. We really want to see this stay above zero. It can cut below zero. There's no, weighted significance to it if we get below zero. It's just more of structure, right? We want to see it stay above zero if we're still considering all of this just a pullback in the market. And that's been my argument all along, right? That this pullback was going to be a lot like the April pullback with a 5 to 7% drawdown before resuming the run. What couldn't be seen is the Japan carry trade unwind and then Volmageddon 2.0 when all those short vol traders got squeezed and had their heads popped. It increased the rate of change to the downside, and we just moved really far, really fast. We've talked about these pin bar reversals before on the daily and the weekly. And there's a lot of these examples on the S&P that you can go back and look how many times we've done that in the past. And it's just a really good setup, a good play. $10-day, 30-minute volume profile. The point of control has moved down now, as we talked about last week. It was very likely going to pull down here. Even if we didn't build any more volume down at this level, it was likely to come down here because we're continuing to lose volume off of this level up here. Every new candle on the right takes away a candle from the left, right? That's how it works. So now that we've brought this down, we don't see a change on where that point of control is unless we get back above 5,500. We get up there, then sure, we could move that point of control up. The thing is, I don't even think that's going to do it because we're going to continue to lose these candles. And I don't think that if we get up there, it'll be enough to bring it up. So this should be the point of control for the week. And that's a really nice structural level, 54.32 cog line. It's underneath us like a support level. Just keep in mind that until we get far enough away, it's not support, right? When we're just chopping back and forth around that level, then we can go above it and below it all we want, like we did back here and here. We have to draw completely away from the range and then come back to it, and then it would act as a support or resistance. The argument starts to get in there on Well, how far do we have to go? And it's not always the same. Generally, you want to just look at what the market's already given you and use that for a range. So we could look back at some structure back here. We're at that distance. We could look at something a little more current. And I would say if we get beyond this, then that's as far as we need to get. And the next time we came down to this level, it would act as a support, or it's supposed to act as a support. We never know it will until it does, right? Support is past tense. It's what has happened. It's not what will happen. Otherwise, we got a nice shallow area on this time frame. Just remember the weekly, the one we were looking at on the intraday chart. There's some volume up here of resistance that's going to be difficult to get through. 5x5 volume profile with TPO. No point of control to carry forward from Friday, so we don't have that. Relatively even distribution, like a D shape. No real insight here so far on the profile for this time frame. It's not offering us any insight. 54.72 is the next VPOC higher, and don't see that today without any sort of news to get us there. We have the new week. Earlier, I was talking about those three labels and the daily expected move. Well, this is the weekly expected move. We looked at this range on Friday and compared it to what we had last week. And at the time, they were looking pretty good. They were looking pretty close to the same. But now we can see that last week had a lot more volatility in it than our new week does. Just at a glance, we can see that there's less volatility priced into the market for this week than last week. Very likely it's because we're waiting on CPI. It's another reason I think we're going to get a sideways week into Wednesday. You know, there's this phrase that says FOMC is a volatility suppressor. And man, I disagreed with that statement the first time I heard it, because have you ever seen what the market does on Wednesdays when we get FOMC? It's all over the place, jumping up and down, and it's very violent. That is not volatility suppressing, right? But the phrase isn't about the report on Wednesday when it comes out. It's about the week of FOMC and how a lot of times on Monday and Tuesday, we don't do anything because we're just sideways waiting on FOMC. And sideways not moving is a lack of volatility. So FOMC is a volatility suppressing event. And this week, so is CPI. So the insight here, the takeaway is that I don't expect the markets to do much Monday and Tuesday because we're waiting on FOMC or CPI on Wednesday. And this kind of backs me up on that. The markets aren't pricing in volatility for this week. We're back above the 10-day. We're basically at the center of the basketball court at this point. We could make moves in either direction, and we've got a full tank of gas to do it, right? That's just a really good way of looking at it. We're in a really healthy space. When you're at the 10, that's healthy. If we were really far underneath the 10, we'd be, oversold. If we're really far above the 10, we're overbought. I hate those phrases, but it's a good way to consider it. We've traveled too far when we're too far away from the 10, right? Too far, too fast. Mean reversion kicks in. But we're right there. So whether it was a correction through time or a correction in price or both, we have corrected. So all of that violence and the big move that we made, we're past that at this point. Market's already self-corrected. We're ready to go. It's like that Terminator that just kept healing itself, right? Well, we're there. We're done. It's healed. So it's going to take longer for investors to get over it, especially retail traders. It's going to take you guys a lot longer to get over that shock and displacement than it is for the market. We're still below the 10-week, but we are working our way back in a systematic fashion. It's just a nice clean stair step back, which is kind of what we want, right? We don't want these big stick bars that drop down and just shoot right back up again, single solo bars. Want a nice clean orderly approach back. Just keep in mind there's plenty of examples where we've started working our way back and then we got news and down we went again, right? We wanted to kind of add to that concept. Turn on CPI. Last month, for an example, 2 days of sideways, and then we got CPI. Or the month before that, 4 days of sideways before we got CPI. Starting to get the idea, yeah? Orale. The month before that, 3 days of sideways. And really, I mean, you could take it a little farther than that. I'm being nice about it, saying 3 days, but we had a whole lot of nothing there before CPI. So base case argument for the week, we don't do nothing Monday and Tuesday. And I know that entices people to do 0-day iron condors, which I'm more in favor of a 0-day iron than I am an iron on the week, right? The weekly iron would be using these levels. Not a big fan of that one in the current environment, but even the day-to-day 0-day irons, they're really dangerous because it wouldn't take much to spark us into a big move. And sure, I showed you, what, 3 or 4 months in a row where we went sideways into CPI, but it only takes one. Those irons in the current environment, if you were to build it, you have to build it really wide, and then you're not going to get very much money for it because you built it really wide. And no matter how wide you build it, you can't build it wide enough to avoid price if the violence comes. So if you do them, I like to break the day down into 2 parts, the morning session and then the afternoon session. Do an iron for the morning and do an iron for the afternoon. Kind of like that, right? I've found that to have much more success than trying to do one for the whole day. And really, legging into the iron would be really nice. So putting on the top side as we're still at the top and then letting it fall into around lunch and then putting on the lower side, just kind of legging into it. Jump to page. Let's go back. I know this is difficult chart for some people. I hear you. I've got your feedback. You're not supposed to look at all of it at once, right? Just hone in on specific parts of the screen and then the totality starts to pick up. Bottom 3 are defense, the top 3 are offense, or another way of saying it is risk on and risk off. The labels are all blue. All of the sectors are positive over a 5-day change in time. They're mostly all back above the 200. There's some stragglers where, we're fighting the 2 or we're just still yet completely underneath it. But for the most part, they're all above the 200. The white line, which is linear regression line, it's still sloped to the right. Maybe not a really sharp 45-degree angle per se, but it still has a slope to it. This is not a crash and burn look, right? We've been talking for months about seeing this rally broaden out into a lot of the other sectors, that the Mag 7 can't continue to carry the markets forever. Or another way is that semiconductors can't continue to carry the market forever, that it's just got to spread out. And I mean, this kind of shows that it is starting. The clock is ticking though, right? Once the Fed starts announcing cuts, like click the stopwatch. Bitcoin is down this morning less than 2%, but I say more than 1.5%. But over a 5-day period, it's still up more than 13.5. So put those two numbers together. Bitcoin was up 15%, and now it's taking a little bit of a pullback. Okay, I mean it kind of earned it. Other than Bitcoin, there's really nothing else. When it comes to TNX, can't use Thinkorswim, right? The screen just stays black and nothing shows up. So no matter what I see on that watch list for TNX, I never trust it because this is what I get. I don't know what the problem is. Somebody broke it. Still got the 10-year below 4%. That's a good environment for small caps. But there's not a lot of trust in small caps. They've continued to underperform, right? Maybe put it on a daily and a weekly, that sentence starts to make more sense. You see what we've done since 2022, a whole lot of nothing. So it's hard to get excited about small caps when they just keep letting us down, right? On a day-to-day basis, these are some really big moves, which is awesome, and that's perfect. But just talking about that bigger picture. Looking at what's up. What's Meta just got news on Universal Music licensing deal. Oh, could see something out of that. So we got nat gas, the Mag 7, gold, gold miners, uranium, banks, metals and mining, not quite there. Give it a little bit more. That's a good start to see the financials up there and the Mag 7, but we want to see just a more general tech up there. More this consumer discretionary. You don't want to rally on pot stocks and nat gas, right? That's not the kind of rally we want. Although it is a little bit of a wink and a nod towards perhaps a short covering, and this is a good time for it, right? I think that kind of fits what we've seen on previous hurry up and wait weeks, where the large caps and sort of the bigger plays, the indexes that we normally look at, are holding the line, waiting on data, and we see a bit of a squeeze and some movement in small caps and heavily shorted names. And then there is the argument about gold making a move on economic event weeks. So silver is up really big this morning. Nice gap up, but we're back to the year-to-date VWAP, and we were in that cluster, and this is just a pullback, just like we've been getting, right? We could even measure the distance of the last leg up and project that for this leg up and just see if we're on track. Uranium is up, but there's no flow there. We can just see there's some algo prints up there at 25, but we're not seeing it do anything yet. And it's still stuck inside of Friday's range. Nothing to see there yet. It says pot stocks are up 1%. Yeah, okay, but it gapped down first, and now it's basically where it closed. So I'm not really excited about them small cap pot stocks at this point, other than maybe as a day trade, we could get a little something. And if we were going to run it, like say they actually start picking up flows and start to run, back to the year-to-date anchored VWAP would be the swing target, 850. And these things are so cheap, right, that you could probably grab a lot of out of the money calls for a penny a piece, and just kind of work the order, grab 100 and 200 of those. Gold and silver, their chart looks a lot alike. Just a leg up on this continued march to the downside. If I was going to work with gold, it would be this last big bar, because that's the bar in control. If you wanted to, you could use this one, but I'm not such a big fan of it. Still, its structure is a lot closer. So be looking for a breakout here and a gap close at this level, and then up to 37 be the upside move. Man, that's noisy. A trend line would be your trouble. Crude, same thing. It's a nice gap up, but we had 3 solid days in a row. We got back above VWAP year to date. VWAP 78 is a significant resistance level. It was the 2-bar reversal, this tweezer top, and those are usually really strong. So I would expect significant resistance at that level, if we can even get to that level, because they'll likely front run it. IB, same thing, a gap up, but it's just an algo print. We're not seeing any flows up there. So look for this to spread out. Could start looking at individual names rather than the sectors in the indexes, because really we're not getting a lot out of that direction. Look at the most heavily weighted names in the NASDAQ for an example. Intel's up almost 1% this morning, or NVIDIA. That's not up very much. On the week, we're still stuck inside of last week's range. Amazon, same thing. Amazon's about ready to break out of its previous week's range. Got this big gap that needs to be filled. Right now, this is a gap down, like an island reversal, but it won't be, quote, a reversal till we get the island gap back up, right? So for right now, this base down here, this is structure. And once we break out of the top of this, say once we get above 170, a nice round number, then we're in no man's land all the way back up into 182 to get this gap closed, 184. That's a big gap. Year to date, anchored VWAP lines up with the measured move of 50%. So around that 177 area. I still think it's more likely that we'll print a lower high, right? So we're talking about a rally up, but not being able to get through that high there. I would be surprised if we actually got to that high, right? And that instead we're much more likely to find some resistance in either of those two locations. And then we roll over, and that would give us another lower high. So then we'd have one lower low, two lower lows, two lower highs, and that is a full set, and that is a trend to the downside. We'll see. Broadcom, another one. You know, this one is one of the Mag 7. Well, let me rephrase. It's one of the FANGs, right? So if you go to Google, and you should check this every once in a while because it does change. Now, this isn't the good one. There's a better one than that one. This one. Intercontinental Exchange, ICE. It's the NYSE FANG Plus Index. It gets rebalanced from time to time. These are the Mag 7 names right now, Snow and AVGO Broadcom. Those two go under the radar a lot. You know what I mean? Like everybody's looking at NVIDIA, Apple, Meta, Google, Microsoft. Of course, everybody. But Snow, if it wasn't on this list, I wouldn't look at Snow. You know what I mean? It's just, what do I care? And I mean, Broadcom, I guess it pops up on my radar with some flows, but I wouldn't look at it if it wasn't on this list. The thing is, it is on the list. So you should be looking at it. It should be a part of your purview. Pot stocks, semiconductors, precious metals, some crude, and financials. But we want to see this really broaden out. Notice we're not seeing things like the China ADRs. So we got BABA here. It's gapped up, but it's still inside of last week's range. Or Baidu, still underneath everything. Friday's midpoint. I think if that Friday's midpoint breaks, we could have a nice shot to the downside. It's already now it's basically flat this morning. It hasn't done much of anything. PDD underneath everything, and it basically flat this morning. So nothing out of the China ADRs. So we want to look for semis to continue to hold the line and the Mag 7 to back them up and then get a little juice out of financials if we're going to get a breakout today. And I'm still going to argue that we likely don't, which is fine on those weeks where we go sideways on the Monday and Tuesday part of it. there's almost always individual stocks that are making moves, and just play that direction. And for the futures, if the ES and the NASDAQ are expecting to go sideways, then run gold or crude, right? Yeah. Gold had a nice leg up. If it's not going to stick, then just giving that move back would be a nice play. And yeah, crude's elevated too. It's not as clean, but it's forming a nice reversal pattern. So yeah, if we're not going to do something in one, just look for something in something else. A little something, something. Everybody, be careful, be safe. Have a good start to the week. I'll see y'all tomorrow.